now I will introduce John Morrison. John grew up in Tyler, Texas. He graduated from Robert E. Lee High School. He attended Baylor University, where he obtained a bachelor's degree in accounting and a master's of taxation. John began his career in public accounting, working in both audit and tax, before adding business valuation and litigation support. From public accounting, he transitioned to corporate financial leadership for regional and national real estate, construction, and development companies. Prior to founding the Morrison Firm, John was chief executive of a multi-billion-dollar real estate fund for the state of Alaska. He holds both a Texas Certified Public Accountant, CPA license, and a Certified Valuation Analyst, a CPA certification, and is a real estate broker, as well as holding several additional license certifications. So John is very well versed in what we're discussing today, and I'd like to welcome John up to the stage. So thank you, John.
Well, thank you all for being here, and I guess those of us joining online. So today we're going to talk about financial fraud and how it affects all of us. It's
John, I'm sorry to interrupt you. Would you mind holding the microphone just for the
Start over.
Perfect. Thank you. Sorry. Sorry.
It is actually much better. I can hear it. I can hear it myself. So fraud is pervasive. I will tell you that even in the work we do that isn't necessarily fraud involved, we often stumble across fraud in places that people would never imagine it was occurring, and it occurs often on a large scale in a way that sometimes you wonder how an organization could continue under the weight of this fraud they were unaware of until that time. So it is all around us. So today I have myself, John Morrison, and I'll introduce Josh here in a minute, who will be carrying most of the water for this presentation. So, at the Morrison Firm, we do a lot of things. We're not attorneys. The only legal advice we give is to get yourself an attorney. So none of this is legal advice. We're a full service CPA firm. We offer controller, CFO and accounting services, tax planning and preparation, business valuation, fraud examination, and other litigation support items where we serve as experts. And then we do transactions and transitions for business sales and other real estate transactions. So with that, I'll introduce Josh Olney. My digital copy here. So Josh attended California State University, San Bernardino, where he obtained his bachelor's degree in administration with a concentration in accounting. Josh began his career in public accounting, working in both audit and tax. He's previously served as an audit supervisor for a regional public accounting firm, accounting and accounts payable manager for a global online retailer, and controller for a national engineering firm prior to joining the Morrison Firm. Josh holds a certified public accountant license in Texas and California. He also holds his certified fraud examiner credential. He is a current member of the Association of Certified Fraud Examiners and the East Texas State Line Council. So with that, I'll hand over the mic to Josh, and he'll guide us through.
So the question is, what is financial fraud? Well, it occurs in nearly all businesses over any length of time. Any business that's been there for years has probably seen some sort of it, whether they've found it or not found it. And so we're going to go through today financial fraud and break it down piece by piece to understand how it occurs, where it occurs, and how we can find it. So it's any activity that relies upon deception in order to achieve a gain. And it's a knowing misrepresentation, concealment of material fact. And so when you're looking at a business, there can be two different pieces of it. There can be error and there can be fraud, and it's very difficult to differentiate between those two. And so that's where the questioning part comes in. And so you have to have a question in mind when you run into it. Because I've run into plenty of error that could be misconstrued which way or the other. So it's a challenge to find it. There are two types of financial fraud, and this is where we get to the breakdown of it. The first type is occupational fraud, And the second type is organizational fraud. And as we go through this, you'll understand the direction and understand which is which. So the first one we're going to talk about is occupational fraud. So this is where an employee, manager, officer, owner commits fraud to the organization's detriment. And this is the key word right there, organizational detriment. So that's how you split between the two different types. 3 types of occupational fraud that occur. First one is financial statement fraud. Second one is asset misappropriation. Third type is corruption. And we'll go through the 3 different types as we move along here. This is what you consider your fraud tree. And as we go, we'll break through this all. Again, you can see how large the asset misappropriation one is. And this is not a complete representative example. There's definitely much more subcategories. And so the problem, you can have a whole slew of problems that come with that. First, we'll start out with financial statement fraud. So here's your fraudster right there. They wear those caps, come to find out. Keywords in this one, it's a deliberate misrepresentation, intentional misstatement, and omission and deception. And intentional is the key word in this one. You can run into a lot of errors out there, and many of them are, most of them I would say, are not intentional. And so I'll try to describe how you would understand the difference between intentional and non-intentional. So why is financial statement fraud committed? Higher purchase price for the business sale of a business. That could also be stock price. So a lot of executives make their money off the value of the shares, whether it be through sale or whether it be through options. And so there's always the incentive to raise the price of a business. To demonstrate increased earnings, allowing distribution and dividend payouts. To cover the inability to generate cash flows, I would say this one's less of what I've seen. It's tougher to cover up cash because at the end of the day, your cash is in your bank what your cash is. There's ways to mess around with it, but it's a little bit more difficult than the other two. And to comply with financial statement covenants on financing. And that's an interesting one because when you get a loan from a bank, somewhere buried in the details of that loan, you're probably going to have some type of covenants. And in those covenants, it's going to tell you certain aspects. You need to keep a current ratio of 1.0. You need to have audited financial statements. You need to have all these various different pieces of it in that contract. Within that, the companies are then forced to meet those covenants. The problem with that is that they may not meet those covenants at a certain time and point, and they don't know that until after the fact. So 2 months come down the road, you're working on your financials for the prior period, and you realize you didn't meet your financial covenant. And the repercussions from the bank can be pretty significant. So there's a huge incentive there for someone to cover it up. And most people don't realize that until you work in an environment where financial covenants become an issue. So that's one to keep in mind right there. And again, to receive your performance-related bonuses. So upper management many times has incentive to increase make the financial statements look better to receive those performance-related bonuses. So these are the common types of financial statement fraud. Some less common, some more common, and we'll kind of run through that. And how it's done. Improper revenue recognition. This one's an easy one to manipulate. So there's different types of accounting. Cash accounting, accrual basis accounting. If you're in a school district, modified accrual basis accounting, or cities. So there's a plethora of different types of accounting. Contracts, agreements will have the type of accounting that should be followed. And so revenue recognition between the different types of accounting can be very different. You can have accrual or you can have cash basis as your general two types. And with accrual, you can manipulate that in various different ways to either increase your accounts receivable or accounts payable, decrease them, and so that's one to look out for there. Manipulation of estimates. So on a balance sheet, there's a lot of estimates. In any audited financial statements, there's lots of estimates, especially when it comes to fixed assets and other different pieces on that balance sheet. And so incentives are to manipulate those estimates to make your financial statements look better. Inventory misstatements. Inventory is a pretty complicated area. There's different ways of holding inventory. And so inventory misstatements are usually a pretty common type of financial statement fraud. Improper accounting for loan impairments. So a lot of times a company may be owed money and they may know that they're not going to receive that money, but they will keep the money on the books, that receivable on the books regardless. And then as I've come in as an auditor, we've had to negotiate with back and forth between the company and say, we don't think you're going to receive that money. So then there comes the question, is it intentional or is this they just didn't know? And so you can see where the gray area kind of fits in there. So you have to look at it from an incentive standpoint to figure out, should we do more work on this? Should we say that this is fraud, or is this an intentional misstatement because it's such a small amount that they would have never realized it anyhow, or maybe they just don't care. Overstated assets or revenue, that kind of goes back to improper revenue recognition. The goal of a company is directional when committing financial statement fraud. They generally want to make the financial statements look better than they actually are. That's usually the incentive. What they will do is they'll attempt to overstate their assets or overstate their revenue or understate their liabilities and understate their expenses. So there we're talking about directional risk. And when I'm looking at financial statements and I'm looking for earmarks of fraud, I'm going to look at that piece right there. I'm going to look at the directional risk to say, is this fraud or is this just an error? So here we have a balance sheet, and we're going to kind of look through this to see what financial statement fraud looks like. And it's kind of on the smaller side, so I'll kind of walk through it. But here you have year one, here you have year two. In year one, you have $330,000 of assets. Year two, you have $425,000 of assets. Now we'll walk through the top piece. So you have, here's a vertical or a horizontal analysis. Here's your vertical analysis up and down. And when I'm looking through this, what I'm looking for is for obviously directional piece of it. So I'm looking for an increase in the current year to tell me where fraud might occur. So the first thing I want to look at is the percentages here. I want to go through a horizontal analysis. This one went 45% to 47%. This one from 23% to 35%. This one went down, and that one went down a little bit. So where's the fraud at? It's most likely right there with your inventory. Why? Because the analysis tells you that there was a change not relative to the rest of the balance sheet. Why they would do that? Well, if you can increase this number here, which is your inventory and ultimately your assets, you can also increase your retained earnings, which makes your company look better. It looks better to whoever you may present those financial statements to. If that had not gone up from $75,000 to $150,000, this right here would not look nearly as good as it would. It would be about 70% lower. So for this company, whoever did that, they're very incentivized to do it because of the amount it makes their company look better. So here are inventory schemes, meaning going back into that last example. And we'll talk about a few of these. And these aren't all the different kind of schemes that occur. It's just kind of what could fit on the page here. And so the first one we're going to talk about is shuttling inventory. So one thing they have to understand is inventories don't always occur at year-end cutoff when they're measured. I've done an inventory as late as a month and a half after, depending on how much activity a business has, and then we can back into the inventory. So that leaves a lot of time to move that inventory around from place to place. You make one count, you go to another place and make another count. If they move that inventory in that time frame, you might have an issue. The second one, and in my opinion, probably the easiest one, is a fictitious journal entry. At the end of the year, your financial statements don't look very good. It's very easy just to make a journal entry for an accountant to do that. It's probably the easiest of all those because you don't have to move anything but a pen and make your financial statements look better. Third one to talk about is manipulation of perpetual inventory figures. Also a pretty easy one to get away with because in my experience, all you have to do is go out to the warehouse and Change the number on the inventory figures, and now you have a new inventory number. It flushes it through the cost of goods sold, and voila, now your financial statements look better. So these are common organizational issues underlying financial statement fraud. This is one that I've run into a lot in practice. It really just is lack of personnel with accounting experience and training. There's so many accountants out there that just don't have the required experience or training or education to do the job that they're doing. The company might have started small, the company's gotten bigger, and they've kept that same accountant there without the required help. Internal controls are huge. Material weaknesses in those are prevalent through society. And going in the years of auditing that I've worked in is I wouldn't be surprised to get every other audit at least a significant deficiency, if not a material weakness in their controls. I mean, we can usually go through there and find something pretty quickly. Unsupported journal entries. So we talked about journal entries. Having supported journal entries is critical to displaying that there is no fraud. Poor tone at the top. A lot of times management may not care. They really don't have an idea of what's happening below them, or in worst case scenarios, they're encouraging it. A high pressure environment. High pressure environments will lead people to do a lot of things. Commit fraud, not pay attention. Sometimes there's just too much work for them to do, so they don't pay attention to it. And inaccurate financial statement disclosures. And I'll kind of tie this back in. I'm sure a few of you out there have received confirmations from audits. I'm sure I see some heads nod out there. So the most common occupational fraud by this considerable degree is asset misappropriation. It's less costly than financial statement fraud, and cash is generally the focal point. Because cash is small, it's easy to conceal leaving a location. It's easy to deal with from those standpoints. If you have huge items of inventory, you have to pull a semi truck up, that's a little bit more noticeable. So cash tends to be the easy one to get out of there with. And so when we talk about misappropriation of cash, these are many of the items that occur. You can have theft of cash on hand, theft of cash receipts, and fraudulent disbursements. First one is skimming, and we'll talk about a cash theft scheme called skimming. So skimming occurs prior to cash being recorded. So if you've ever gone to a drive-thru, you may see that they want you to keep your receipt and then send that receipt back into them. That's because they're concerned about cash skimming. Before that money hits the register till, they're concerned the employee is going to take it. So when you see that sticker on a window, that's what the company's trying to put a control in place to deal with. It's more difficult to detect because there is no audit trail. It has not been entered into the records yet. And it is one of the most common types of occupational fraud run into. And who's at risk to commit it are employees who receive cash directly from customers. So we'll kind of talk about a skimming example here really quickly. So an employee responsible for receiving ticket and fine payments on behalf of a municipality abused their position and stole incoming revenues for nearly 2 years. When payments in currency were received by the individual, they issued receipts, but when the checks were received, they did not issue receipts. The check payments were therefore unrecorded revenues ripe for skimming. The unrecorded checks were placed in the day's receipts and an equal amount of cash was removed. The receipts matched the amount of money on hand, except that the payments in currency had been replaced with checks. So really the issue there is one person was doing everything and it lacked the controls. I've audited a few cities, and really a lot of the smaller cities are ripe for that because there's not enough people within that business office to deal with all the activity that's occurring. And so when you have 2 or 3 people in an office, it's really hard to segregate controls. Second type, theft scheme is cash larceny. So it's after cash is recorded. It's easier to detect because there's an audit trail because it's been recorded into the records. Less common, and employees who handle cash after it has been recorded. So that would be who would commit the crime. We'll go back to just a quick example on that. So in this case, an employee received a cash payment and posted the customer payment to the accounts receivable journal, but stole the cash received. This resulted in imbalance in the victim's company cash account. But the perpetrator had control over the company deposits and all its ledgers. This allowed the employee to conceal the crime by making unsupported journal entry in the company's books that produced a fictitious balance between receipts and ledgers. So again, this one is proper segregation of duties. That means within the business, they weren't segregating the duties amongst many people. The ways to have caught that would have been a monthly approval or review of the journal entries within the organization. So that's a common control. And many times nowadays you can do it through, your accounting software system may have that control built into it. So you can post a journal entry, but someone's going to have to go approve that. And that's a control right there that probably would have caught that.
I have a question.
Sure.
I'm not a CPA or anything. What is a journal entry?
So a journal entry is a manual method of adjusting the numbers within the financial statements. You have your debit and your credit. They have to balance to each other, but they affect either your balance sheet items or your income statement items. And so when the journal entries are made, many of them are made on a month-end basis to make manual adjustments. And within that, if they don't have support for those adjustments, they're a very susceptible area for fraudulent activity. Because it's one person making an entry to say what that person thinks is happening within that company. So usually there's less controls involved with it. It can be a really kind of tenuous area.
So things are out of balance and they've got a balance, or somebody goes in and says, I balance it by saying this.
Exactly. So that's traditionally how they should work. So if I have a loan statement and my financial statements don't match my loan statement that I got from the bank, someone can go in and create a journal entry and make it match. When you run into the problem is when maybe you have your accounting records and your loan statement already matched, and you don't like that number, and so you create a journal entry that lowers that loan balance, and now you have increased your equity in the value of that business. And that's where the fraud occurs at. And so there's ways, audit techniques will find those and compare those balances to make sure that they drive. This is an interesting one. Fraudulent disbursements, and this is a big risk area too. The employee makes a distribution of company funds for a dishonest purpose, difficult to detect, and very common. So the types of employees that would be perpetrating this one would be those that would authorize vendors and payment of expenses. So this is a really interesting one. This example here, I got to see this one firsthand, so this is my own experience of this. So a director of international shipping was authorized the addition to add a fraudulent freight forwarding vendor owned by the director's son. The freight forwarding vendor remitted invoices to the director, who approved the invoices and submitted the invoices for payment. The invoices were paid monthly for over 2 years, amounting to approximately $200,000 in fraudulent disbursements. Management, suspicious of the activity, reviewed the freight forwarder's estate filings on the Secretary of State's website, noting that the son was listed as a registered agent. The director was terminated and no charges were filed. Of note, and this is the interesting part, the director was hired in a similar role by a directly competing company shortly after being terminated. So the company had effectively poison-pilled their competitors. Missing controls. Adequate vendor approval and additional process, secondary review of new vendor requests, ongoing maintenance of approved vendor lists, and limits on the amounts and types of purchases that could be made by employees. So any one of those controls may have caught it. If you put all those controls together, they probably don't get away with it. And so there has to be multiple people in the process. And so as you're out there in the world and you see something, if you see one person controlling something from start to finish, that should be a red flag right away, that there could be something there. So corruption schemes is one of our other types of frauds out there. We have bribery, kickbacks, illegal gratuities, economic extortion, collusion. And I'll give a quick example here. This is actually one in Texas. How much time do I have left? I'm on time here.
30 minutes.
30 minutes, all right, awesome, okay. So this is a longer example, that's why I asked, so. To make sure that I don't spend too much time on this one and
We like stories, so go ahead.
yeah, this is a good one, and I didn't find that this one has actually gone to court. It's kind of still hanging out there. So, founders of several lab companies paid kickbacks to induce medical professionals to order medically unnecessary lab tests, which they then billed to Medicare and other federal healthcare programs. The medical professionals, including internal medicine specialists, a family medicine practitioner, and a nurse practitioner, accepted the bribes and ordered millions of dollars worth of tests. The lab companies disguised the kickbacks as a legitimate business transaction, such as medical advisor agreement payments, salary offsets, lease payments, and marketing commissions. The labs, through marketers, paid doctors hundreds of thousands of dollars for advisory services which were never performed in return for lab test referrals. They also allegedly paid portions of the doctors' staff salaries and a portion of their office leases. These were contingent on the number of lab tests referred each month. In one instance, lab marketers even made a direct payment to the provider's spouse. Knowing they could disguise additional kickbacks using a provider ownership model, the founders offered physicians ownership opportunities only if those physicians referred an adequate number of lab tests. In some cases, they made advanced disbursement payments to physicians in an effort to appease the physicians and ensure they would not send samples to other labs. As a result of these kickbacks, laboratories controlled by the defendants were able to submit more than $300 million in billing to federal government healthcare programs. Between 2015 and 2018, one doctor alone received more than $400,000 in kickbacks for ordering more than $4 million worth of lab tests, and another doctor received more than $300,000 in kickbacks for ordering more than $12 million worth of lab tests. The charges in total resulted in 10 indictments, and with the amount of $300 million, I'm suspecting there'll probably be more. Yes?
That'd be a case pending now in the Eastern District of Texas.
I thought it was in the northern, but it could be that one. It's an interesting one I ran across when I was doing research for this, and I felt that because the Tyler area is growing with the medical industry, that it was relevant to what we do here in this town. And so I wanted to point that out and show you an example of how corruption can occur. Also, medical corruption, it's a huge deal. It's really more than its fair share of fraud that occurs. All right, so how do organizations deal with fraud when they run across it? And so this is the ACFE's 2020 report to the nations, and that's the Association of Certified Fraud Examiners. So 80% of the organizations gave the perpetrators some type of internal punishment. I'm guessing most of that is terminate them, and maybe sometimes they'll keep them around, but so punishment's handed out. 59% referred to law enforcement for prosecution, so when they ran across it, almost 60% sent them out. 56% pleaded guilty or no contest. So of those, they're gonna plead guilty right away, or after some time maybe. And 23 were convicted at trial. And so then we'll talk about why they decline to refer cases to law enforcement. So why a company won't refer somebody out. A lot of companies think that internal discipline is sufficient. They don't feel that it's gonna help or help them in any way. It's really how's it gonna help the company, and so they don't deal with it. 32% fear of bad publicity, so they think they're going to get bad publicity out of it, which depending on the organization, I can see that happening. Because 27% private settlement. 17% of the organizations think it's too costly. 10% of the organizations don't have the evidence. 6% civil suit is happening, so they're not going to pursue. And then in 1% of the cases, the perpetrator disappears. And I was surprised. I thought that would be more, but it 1%, so we'll go with it. So that's the one that surprised me the most. All All right, so the second type of fraud, so we talked about occupational fraud. This is now organizational fraud. So organizational fraud is a crime that involves illegal offenses committed by individuals in the course of their occupation. So how this differs from occupational fraud is occupational fraud hurts the business, organizational fraud helps the business. And that's how you can differentiate between the two and start going down that path. So typically committed by businesses, government, and occurs in the context of very complex relationships. It can be stakeholders, it can be banks, it can be whatever it may be out there, but that's where it occurs. So the overall picture of organizational crime, where does it fit into the scheme of things there? So you really have two pieces. You have the fraud piece, which is 22% of organizational crime, and the bribery piece, which is 7.8%. And these are the other types of crimes that are out there. So the types of fraud offenses that are out there, mail and wire fraud, that's kind of a catch-all right there. If someone does something wrong, and this is usually one that they get caught by. False statements, 30%, bank fraud 10, healthcare 10. So again, this is a big one, probably compared to what I would expect it to be. And other 5%. So organizational offender characteristics. So these are the characteristics of the offenders. And this again is from the Association of Certified Fraud Examiners 2020 report. 86% closely held with private corporations. 7% were publicly traded companies. 86% of those were employed fewer than 50%, and only 8% employed more than 1,000 employees. And 13% had a history of misconduct. So what it tells us, the overall piece of it is they're not big businesses and they haven't been caught before. So they're first-time offenders, or caught the first time, I should say, and they're usually not that big. And so the businesses in this area typically fit into that characteristic there. And so big businesses have more eyes on them, and it's tougher to go in with. When you have sets of auditors or auditors that are in your building 24/7, it's a little tougher to do. So that is that piece. So we'll talk about when to call us, and that kind of brings John up, and we can discuss that a little bit further.
Thank you, Josh.
Yeah.
Nice to see you. Might as well just hang around up here.
Yeah.
Sure, some more questions. So when to call us. So clearly, fraud investigation. If you feel like you're a part of an organization, a stakeholder organization, and you've got some questions about things you don't understand or things that might have had the results that you weren't expecting, as Josh indicated, there's some times where there's some questions about these things that just don't feel right. We could come in and kind of look at it and differentiate between mistakes and intentional actions. Of course, many of the same, y'all are probably more familiar, especially with divorce attorneys, with tracing and characterization. This same skill set, these same procedures are often used in tracing and characterization exercise. Shareholder disputes, many times the shareholder disputes are specifically with one person or another got more than another person thinks they should have gotten, and once again we can go in and parse that out for you. Other general just financial analysis, back to the idea of is this within the statistical norms? Are there other things at play here? And at the end of the day, what do the dollars and cents actually say, as opposed to I just feel like they got more than they should? Internal controls testing. This is what I would consider being important. As he talked about, in a small organization, internal controls just means that you are on the outset putting things in place that would not give someone the ability to do any of the many things that are available when someone has control over the whole process. If I get the check and I take the check to the bank and I get the bank statement and I record it in the thing and there's no one else involved, well, there's no one to see what I'm doing. But if there are other people involved at certain specific steps and processes, then all of a sudden someone would have to collude with someone else, and that becomes much more difficult to get your friend involved in stealing from the company than to just do it yourself. So that's internal controls, and like I said, in the type of businesses and organizations in East Texas where there might only be 2 or 3 people in the whole accounting department, sometimes you have to get a little bit creative to bring in others in the organization who you might not think on the outset could be involved, just to make sure things are done appropriately, that we can help set those plans up. Also do calculation of the damages work, how much, we found this one transaction, or we found this one issue, how much did they actually steal, and or to go further than that, how much did it affect other values of the company or other business the company might have had. And then of course, forensic accounting is kind of inclusive of several of these things, just what happened after the fact, and kind of digging in to just say, once again, we think something's wrong here, and we can go parse out and choose the areas that might make the most sense to look into. So once again, levels of service for these. First off, we do offer just a general consultation where we're happy to meet with the stakeholders, explain some of our processes, hear your concerns, and help guide a path that you want to take, the next steps, or maybe determine there are no next steps to take. We could then also do some initial investigation of your concerns. Once again, just gather some information, talk to you about it. Once again, next step, see if there's anything else to do. We will also actually go to litigation support. That could include, preparation of the reports necessary to negotiate with the other side, and/or, provide expert testimony in court. And that really does fall into fraud examinations and then the expert testimony, like we said. And then one of the other things is key as part of the thing is it is amazing what people will tell you when you just sit down and ask them. Many times these people, or occupational fraud often happens when someone finds an opportunity and it doesn't get caught the first time. And a lot of times they make a mistake and they realize that they can get caught, and then they think, well, maybe nobody will ever catch me, and then they do it again, and then all of a sudden they've convinced themselves it's okay for any number of reasons. And oftentimes when it finally comes down to it, sometimes it's been years and huge amounts of money, and you sit down with them and just say, hey, I'm here to talk about this, do you have anything you want to tell me? And they'll just tell you, I've been stealing the company for 3 years, and I'm happy you're here because I feel really bad about it. You go, well, let's talk some more about that. Maybe this is the last day. We won't do this. Won't do this anymore. But anyway, so like I said, sometimes just sitting down with the right knowledge of the questions to ask and get into the situation. And of course, then stakeholder reporting. We often think about businesses and whatnot, but this happens in all organizations. It happens in the government, happens in nonprofits, happens in businesses, and so there are different stakeholders involved in each one of those type of organizations. So oftentimes we'll need to go back and report to a board what we found, or another governing council of some regard. So that's also something we can do, both on the front end to help them understand what happened, and then also what has been done to change it so that it won't happen into the organization. So when you're thinking about hiring an expert or someone to help you with this, definitely some things you need to think about. One, experience and their qualifications, both direct in the issue you're working with, as well as just overall. Of course, you want the appropriate licensing and certifications, and in that regard, in addition to being CPAs who are naturally, it's kind of something CPAs would do. It's also important to have some additional specific certifications and acquisition of the knowledge base necessary to do this. And in that regard, like I said, we have the Association of Certified Fraud Examiners, which has the Certified Fraud Examiner designation, which Josh holds. Certified in Financial Forensics, which the AICPA grants. What is the CFS? Sorry.
Yeah, I wrote those down because I knew.
We love acronyms. There we go. We love acronyms in accounting. We got it. Oh, Certified Fraud Specialist by the Institute of Certified Forensic Accountants. I'll admit that one was a new one for me. I hadn't heard of it. And then the Master Analyst in Financial Forensics by the SCBA. So, like I said, it is important that someone is actually specialized and holds that additional knowledge base to effectively complete one of these assignments. So, with that, we had a few questions during the presentation, but we'd be happy to entertain some additional questions or comments now.
I have one.
Yes, ma'am.
And this is a story of a law firm here in town, small number of employees, and employee was embezzling as money came in. And so the impact on reported income, which is what he actually, his whole tax scheme, because she did this over a period of years, she was prosecuted by Smith County, but I remember him saying, what am I going to do to the IRS, because it just skewed everything. So what does a business do when they realize they've had this huge loss, that they have unreported income and all this kind of stuff?
That's a great question. Yeah, and so that's one of the things. The fraudsters certainly aren't taking any of this into account when they're doing it. They're only thinking about themselves. But in that regard, yeah, the IRS would, whether the money got stolen from you or not, it was still income you had. And frankly, they would probably also not want you to deduct the loss of not getting the income. So in that case, you're right. That would be a double whammy of paying taxes on income you didn't actually get. And to reiterate, I'm familiar with that story. But I mean, to reiterate, we have found just even not in fraud examinations in the last 3 years on assignments we have been involved in, I have found our firm has found 3 different owners of businesses stealing from the businesses, and the other owners didn't know. And I mean, we're talking more than one case was more than $500,000. And so that's one of those things you think, oh, I'm in business with this person. We're partners. We're in this together. Not necessarily. So, but I mean, they were all internal control issues. I'll get you a second. One was the president of the company who would walk in and have a contract administrator sign a check at Friday at 4. Once again, we've got a bad tone at the top. We've got pressure. We've got urgency. I need you to sign this check or get this out the door, or cut a check. He couldn't cut a check, but he was the signer. And he built a $250,000 pool in the back of his backyard on a mini storage project. And so it's not, you can't look at a situation and think, well, there's no one in the situation that's going to steal. I mean, he there were no internal controls, and he just ran roughshod over this poor construction administrator who didn't want to lose her job. And so, anyway, but yes, sir.
So what are some specific things we can do in our law firms to place some of these internal controls so we're not the victims of this type of law?
You want to take that, Josh?
Yeah. So I think segregation of duties is a big one. And when you think of segregation of those duties, there's an acronym that I like to use, CAR. Because if you don't put them in place, you'll walk out to the employee parking lot and they'll be driving a really nice car on your dime. So the acronym is actually custody, authorization, and recording. And so if you split those 3 up and give a person only one of those duties, it makes theft or fraud much more difficult to perpetrate. Also, review is important, because being a lot of smaller businesses around here, you may not have enough people to segregate the duties well. The larger a business gets, the easier it is to segregate those duties. So management review is critical. So identifying those areas that are susceptible and putting management review in place.
I would also say, in that regard, one of the great ways to add some of that additional oversight is by hiring an outside accounting firm to take one of those, to fill in one of those roles. In other words, if someone, once again, you're going to have an office manager or something who's very involved in the day-to-day business. And if once a month an outside party comes in and reconciles all the things and makes sure they matches, even just the knowledge that that person is going to be there is oftentimes a very good deterrent. Yes, sir.
We all know lawyers that have been swindled by somebody in their office, but really one of the best ways to do it is to the owner, the lawyer, to get a copy of not a copy, to get your bank statements every month and look at and see, who signed these checks. For example.
Well, that was definitely, I tell all my business owners, in fact, for other financial consulting reasons, I say, don't ever give anybody else check writing authority. If nothing else, I mean, it's just really good for you to know what's going out the door, and when you have to sign that check, you go, oh, that's how much we pay in rent, or that's how much the gas bill is, or I don't think I've signed the gas bill this month. Is it gonna get cut off, or, I mean, so there's a lot of good reasons to be the only check signer in a small business. But the risk is, actually on the other side, many people will allow someone else to receive the money and assume it's all just going into the bank. But once again, if someone receives the checks, records it in your account, takes the check to the bank, and gets the bank statement, it's very easy in that situation for the revenue or the invoice to disappear from your system and the bank to not make it to your bank account, and you won't notice. Yes, sir.
Just kind of go back to your presentation. Can you give us a couple examples of financial covenants that these may be breached or something like that would cause them to change their financial statement?
Sure, and I'm going to go into the balance sheet portion that we looked at earlier, and we looked at assets. So on the second part of that, you have your liabilities, and those are broken up into current assets and current liabilities. So things that you'll receive within the year or liabilities that you'll have to pay out during the year. And one of those covenants may be what's called a current ratio. And that current ratio says you need to keep a certain amount of your current assets to cover those current liabilities, because once you get to a certain level, we as the bank or whoever, the lender, let's call them, we're now at risk of you going out of business. You are now a going concern. And so they'll put a covenant in there that says keep a current ratio of 0.5 or 1, enough money to cover the next year. There's also very different ratios that they'll put in there. And so those calculations will come off the last quarter's balance sheet or maybe the audited financial statements. And so during that process, they may not have known at the end of the year there's an issue, and then all of a sudden there's a big issue.
Well, we certainly appreciate everyone having to be a resource for y'all if this you'd like to discuss it afterwards. And thank you for the opportunity.
All right, that concludes today. Thank you all so much for coming out. Don't forget to sign the sheets going around to get your credit for the CLE, or you can use the QR code